Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
And we're back once again. Hey, if you have any questions, feel free to call us 216-901-0945, 216-901-0945. As the man said, this is Bill Bullington. I'm here every Saturday morning from 11 to noon. This show is also available on Apple iTunes as a podcast. So if you miss it, you can pick it up there, or you can go to my website, bullingtoncapital.com, where we also download it, where you can download it as a podcast. Listen to it anytime you want. Not sure why anybody would want to do that. I wouldn't. But again, I'm the guy that prepares all the information, so it's old news to me. But I did want to start off a little bit and talk about we've got an upcoming workshop. You can go to my website to find out about it. It's finding an investment style that suits you. That is so important. Actually, it's probably the most important thing you can do as an investor is take a look at the various types of investment strategies that are out there. Try to match up your personality with the strategy you think most suits you. And we're going to be talking about that a little bit today. We're going to go into detail on the workshop. That's on May 11th, by the way. We're going to talk about why that's so important and how the average investor, according to Dalbar, marketing research firm whose main claim to fame is studying investor behavior. The average investor is not very hard to beat, quite frankly, which is kind of interesting because they tend to manage their money with their emotions rather than what they know. And a large part of the reason that they rely on emotions is there aren't a lot of resources out there. As I'm looking around, I'm looking at the resources that are available to give real quality education as to different types of investments, different styles. Most of them are written for academics or people that are in the industry, and they don't write in everyday language that somebody who's got a 9-to-5 job and has kids can understand. And even if you don't have a 9-to-5 job, the work involved in trying to understand what people are doing with their money is incredible. It blows my mind how these guys go out of their way, it seems like, to make it as complicated as possible, and it's not that complicated. I promise you it's not. In fact, at the workshop, one of the things I'm going to do is I'm going to show you how to look up a mutual fund, look up the top 10 holdings, and apply a valuation approach to it. Just basically try to figure out what those holdings are worth. And when you see that in the top 10 holdings, that 5 out of the 10 stocks are overpriced, what that means is that fund manager probably just got lucky. That's what that means. It just got lucky. And you're hoping that they're not going to hold on to that stuff. So knowing how to do this little exercise, this is really a big help for anybody that's got money in the stock market. Now today, because of 401k plans, retirement plans, almost everybody has money in the stock market. About 85% of U.S. households have at least some money in a mutual fund somewhere, even if it's only a couple $1,000. So, but a lot of people have a substantial portion of their money in stocks, and they don't know how to do this exercise. And I can tell you that the average investment professional, the average investment advisor, doesn't know how to do what I'm about to show you. They don't. They don't teach this. I'm going through another course right now. Of course, I love taking courses. And I'm telling you, it's just not something that's taught unless you get to an incredibly high level, which the vast majority of people that are working every day in the industry are not doing. If you're an academic, if you're a professor, you've probably seen some of this stuff before. But it's just not very common. And the thing that's killing me about it is it's relatively simple. In fact, we've been talking about it for quite a while. I even built a new model to try to take advantage of the fact that a lot of stocks have not participated in the rally that the market's had over the past 12 to 18 months or so. And by the way, the S&P 500, it's only up about 15% or so above where it was 3 years ago. So don't let them fool you. That's another thing that kind of kills me when you're looking at the most recent data. Market hit a new high, yeah, and then it backs off again. It'll go up by half of 1%, and they start waving the flags and promoting that, and then it drops back. And it's been doing that for so long, and it hasn't made a lot of money in the past 3 years, but people are being misled to think that yet they're missing the boat, that the market's done incredibly well, and it hasn't done that well. The last 3 years have not been that good. Is it better than a CD? Yep, it's a lot better than a CD, that's for sure. But the overall, the results are not they're not spectacular. Let me put it that way. Better than a CD, but not spectacular. And there are certain areas that have been left out that have not participated at all. This is where I see there's some opportunity here. And it ties right into what we were talking about, into getting a style that suits you. If you want to beat the market in the long run, you've got to be willing to underperform it in the short run. In the short run, unfortunately, sometimes it's several years. Yeah, that's just the way that it works. Another misunderstanding by the general public that in order to beat the market, you've got to beat it every year, every week, every month. That's not going to happen. It's just not going to happen. If you want to keep up with the market, you're still not going to keep up with it every year, every week, every month, unless you invest directly into an index fund that invests in those stocks that you're comparing yourself against. So that, if you're going to do that, you better find the cheapest one that you can because the cost is going to make a difference. And you better be prepared to have little or no returns for a 10-year time period, because that can and will happen again. It's happened multiple times past 100 years or so. A decade with negative returns by doing, investing in the S&P 500. If you're okay with that, so am I. That's my opinion. If you're okay with that, then so am I. And forget the idea of I'll know when to jump out, or I'll know and jump back in, or that my advisor is going to know that, because the people that have done that are more numerous. Are less numerous than the people who have attended a Super Bowl where the Browns played. I'm just kidding. Hey, listen, you know what? I'm getting actually kind of bored already. You can call us 216-901-0945 if you have a question. But, and again, I feel bad. I talk so fast and I talk about so many different ideas. It's kind of how my brain works. But there is a really simple way of evaluating a mutual fund. It takes time. I will tell you that. It does take time. And I know that's one of the things people are very short of. But if you're really going to be an investor and you're really going to take a lot of time and you really want to understand what your investment advisors are telling you, then you probably need to get to that seminar. So I'm going to show you a little formula. In fact, writing a little ebook on this formula. I think it's a great one. I think it's one of the best ones I've ever seen. And I didn't invent it, by the way. Yeah, so I know anybody that invents their own stuff always thinks it's the best, but this is somebody else's idea. And I've just been around long enough to know, hey, that's a good one. Kind of like Milton Berle used to say, he knew a good joke when he stole one. I know a good idea when I take one. Been around the block a few times. It's really cool. And all I'm doing is taking the earnings before interest and taxes. That's an acronym called EBIT, earnings before interest and taxes. And I'm dividing it by the enterprise value, and that's essentially what somebody would pay to buy the whole business. It's the value of the stock plus their debt minus the cash that you'd get back. And the some yahoos wanted to make that really complicated. They're adding the minority interest in other businesses. Well, if that's a big deal, that it's probably less than 1% of the time that actually makes a substantial difference. So basically, add the value of the stock plus the debt minus the cash, and there you go. Vast majority of the time, that's called enterprise value. That's what Warren Buffett looks at. When he buys a company, he knows he's going to have to assume the debt. when a big private equity firm buys a company, that's what they're looking at. How much is it going to cost us to buy this whole business? And how much cash can we expect to generate? Now, earnings before interest and taxes is just an estimate. It's a rough estimate. And there are lots of reasons that I like to use it. There are lots of reasons that people that brought that out like to use it. It's a little bit cleaner than net income, although none of the numbers are completely telling a completely accurate picture of the entire profitability of a business. But it's a great place to start. And that's the key. It's a great place to start because there are only a few thousand stocks that you have to look at if you're going to be an investor and if you're going to manage money professionally. So you've got to have a place to start. And that's one of the great places to start is looking at operating income. Yeah. And I also understand that occasionally there will be some income included in the earnings before interest and taxes that's not a part of their normal daily exercise. But that too is also relatively rare. So what we're trying to do here is find something that we can sift through the vast majority of companies with to find out those that have characteristics that would warrant further investigation. Think about that for a second. So we're trying to take something that's a little robust. That means it's flexible. We're going to apply that rule, and then that's going to narrow our list down to stocks that we can investigate further. So it's a great time saver. And in fact, you could actually run an entire portfolio with that one formula. And when you're looking at a mutual fund, if you're looking at a mutual fund, you can apply that formula to the top 10 holdings in the mutual fund. And you can see right away when a fund manager just got lucky because he's holding a bunch of stocks that don't have any operating income and the share prices happen to go up. Okay. Or somebody who's actually doing a due diligent exercise on their own before they invest in the stocks that they're putting their shareholders' money into. So I know that's probably as clear as mud. That's why we do the seminars. It's a little bit easier, and we'll have a couple videos on that particular topic coming out soon. We got a couple of them that are already cut. I've been holding them back, trying to get the final edit done exactly the way I want it. But it'll be out relatively quickly. And this is a very good tool for the average investor. It's not that hard. And let me give you an example. I'll give you a real quick example. Say a company ABC. This is a hypothetical company. Company ABC has, it's got 100 million shares outstanding and it's selling for $100 a share, which I believe is about $1 billion. My math could be wrong. It's early in the morning to be doing that in your head. So let's just say that the stock value, the market capital is about $1 billion and they don't have any debt to speak of. Or actually the debt that they have enough cash that they could actually pay it off. Okay, so the net debt is zero. So if you're going to buy that company, you're paying $1 billion for it. And their income from operations last year was $100 million. $100 million bucks, or earnings before interest and taxes in lieu of operating income, because they're very, very similar. So $100 million bucks is 10% of $1 billion, right? 10%, that's pretty good. $100 billion. I'm saying $100 million. You get $100 million. If I buy that business, I'm going to, pay $1 billion for it. I'm going to get $100 million. Cool. That's a 10% operating income yield. Okay, so now I can compare this to company B. Let's say that's a company ABC. So this is DEF. This is company DEF. And it also has $1 billion in market value of their stock. But it has net debt of another $1 billion. So if I buy company DEF, I'm going to have to pay that debt off. Plus, I'm buying all the shares of stock. So I'm paying $2 billion. $2 billion. And if they also had $100 million in earnings before interest and taxes, that is only a 5% return. Now, this is where it gets interesting, see, because when you're looking at just the value of the stock, which is typically all that gets reported in the Wall Street Journal or or Investors Business Daily or Barron's, They're not talking about enterprise value in there, and they typically talk about market capitalization. That's just the value of the stock. It would appear as though the returns are fairly similar because you're forgetting the debt. But when you use enterprise value, which includes the debt, now you're dividing the cost of the entire business, $2 billion, or you're dividing $100 million by the $2 billion, which means $100 billion is only 5% of $2 billion. And if you're only looking at the value of the stock, they would look the same. 100 million divided by $1 billion is 10% on both companies, but one company's got debt. So what's happening here? The company with debt now is showing that you would actually only earn 5% on your money if you were to buy it. The company without the debt, you're earning 10%. And now which one do you want? Do you want the one that's 5% or 10%? Not a trick question. You obviously want the 10%. So that's what I'm talking about. You can do that little exercise with all the stocks in the top 10 stocks in a mutual fund, and you can get a really good idea of how aggressive or how conservative those portfolio managers are being. How cool is that? And you can find all that information up on the internet, and that stuff is free. Okay, you can get that. You can literally get that for free. Okay, and I'm going to show you where at the workshop. I'm going to show you where to find this stuff and how to evaluate a mutual fund. Now, one of the reasons I'm showing this, I'm not trying to put myself out of business here to teach you to do what I'm doing, because you're going to see that it's actually a lot like work. There is a lot of effort that goes into it. And when people call in the future, because of an awful lot of things that are happening in my industry, when people call and ask us, can you take a look at my 401k or my 403b, or can you take a look at this investment or this mutual fund? Tell me what you think. Quite frankly, unless I'm managing the money, I can't do that. I could be liable for some information that I passed on to you, and it's out of my control. So unfortunately, I'm going to have to teach you how to do that yourself. And I'm going to have to default back to the most conservative answer I can give you, as you have to contact the advisors to your retirement plan now. You have them. They all do. And if they don't, you might want to go to your management and say, hey, you know what? You guys are supposed to have you guys are supposed to have advisors here to help us out with this, because they are. That Department of Labor rule that they keep talking about putting into place, I've been reading more and more about it. Interesting, to say the least. But now that I hear the music, that means I have to take a commercial break. You're listening to Bill Bullington right here on 1420 The Answer. I'll be back right after these messages. That is so funny, that music coming back in. That's the music that I originally started using back in 1996 when I first started this radio program. It is hard to believe it's been 21 years. I can't believe it. Time, wow. Man, does time fly. And in fact, at that time, I called this show Show Me the Money. And because the movie with Tom Cruise, I forgot what the name of the movie is. I still can't hear. Oh, that's right. Jerry Maguire. That movie was brand new. And we got a clip of his voice screaming, "Show me the money." That was pretty funny. So brings back a lot of memories. Anyway, so we're just talking about there's a little formula you can use to kind of evaluate how risky or aggressive a mutual fund is. This can be a big help if you're looking at your 401k plans. Again, I feel really bad for people. The country's getting so litigious. We're not. It's not good practice for people in my position to look over a 401k plan unless we're actually managing it. If we're managing it, which means we have to bill on it, then we can look it over and we can give you advice on that. But we're not allowed to do that. You could do it, but you're liable for that advice that you're giving. I wouldn't be as liable for the education. So this upcoming workshop, we're going to be talking about that. I've got a couple of strategies that I use that this applies to. The dividend model that I use is actually very similar to this, by the way. But instead of the dividend, a lot of the small, medium-sized companies have not participated over the past couple of years the way that the larger companies have. And now there's kind of a gap between the valuations in some of the larger, more high-quality companies and a lot of the higher quality medium and small cap companies. In fact, there's a big gap there. And one of the areas that's getting a huge amount of negative press, by the way, is retail. And I'll tell you, there look to be some fairly compelling buys in retail. I know that this is one of the things when you're talking about your personality as an investor that you have to kind of come to grips with. Are you a contrarian, a value-oriented, a deep value investor, somebody who's looking for stuff that's significantly undervalued? Or are you someone who would rather pay a little bit more for higher quality, understanding that you may not make as much money, but you feel more comfortable doing that? That's a big decision. That's a tough one. So it's kind of like the decision. No, it's actually not like this. I was going to say on CDs. Before the seminar starts, we're actually going to talk about a service. I tried to roll this out a little over a year ago, I think, and the platform just wasn't ready. We really struggled hard to try to get it, so I ended up having to put it on the shelf for a while. And we're going to bring this back out, and it's shopping for CDs. I'm looking at one of my custodians, and they have a marketplace for CDs that we can go in. As an advisor, I can go in and buy CDs for people if that's what they want. And I'm looking at the best CD rates on bankrate.com across the country, the highest CD rates that these guys are advertising anyway. And the rates are about 0.25% higher. That's kind of a lot. And when you're looking at, if you're looking at $1 million, it's a lot. It's $2,500. So that's kind of a lot. And there's a marketplace where you can buy and sell CDs for that portion of your money that you want to keep super safe. And I think that's a good idea. If you want to keep super safe, and the rates right now, a little over 2.5 on a 5-year CD. The difference between there are lots of differences, by the way. And again, we're going to cover this in detail at a little pre-seminar. It's going to start at 6:30. That's not on the website, by the way. Yeah, I'm telling you that here on the show. I'm not going to advertise that on the website. So we're going to start a little bit early, and we'll show you how you can shop for CDs. We can actually do this for people if they want us to. As clients, if you've got an account and you want to do this, the fees are incredibly small to do this. And why am I doing it? Because I think it's the right thing to do. I think there are an awful lot of people who would sleep better knowing that they've got a lot of money locked up in CDs with FDIC insurance. I'm sure they would. You know how you only get $250,000 worth of FDIC insurance at a bank? So you have to have a bunch of bank accounts? You don't have to do that anymore. We have a custodian who will allow us to buy multiple CDs from different banks all across the country. They've actually created an exchange for CDs. Banks buy and sell CDs from each other, and brokerage firms participate in that. All has FDIC insurance. What does that mean? It means you could have $10, $15, $20 million in CDs, and all of it's insured as long as $250,000 of it is not not in the same bank. So you can buy them from all over the country. And that is a really cool thing. I'm seeing Goldman Sachs Bank. They've got a bank. American Express has a bank. The Capital One's got banks. There's a bunch of them that I'm just reading off. So again, you might want to get to the workshop because again, it's going to be early. There's no mention of this on the website, and it's going to start about 6:30. Yeah, I'm going to go a half an hour and do that, and then we'll take a break. The regular workshop begins at 7:30, and that's when I'm going to show you how to convert a company into a CD-like yield so that you can compare them too. And it's what we were talking about a little bit earlier in the program. You take the company's operating income, divide it by the cost of buying the whole business, and now you got a yield that you can compare to CDs or other companies. And the idea is that you'd like to get the companies that are giving the best cash yields. Why? Because a firm that goes out and buys businesses, that's what they're looking for. Not that you're going to go out and look to buy companies that are going to get bought out at premiums, like Panera Bread just got bought out at a premium. by a big organization. But that's the way to invest for an awful lot of people. It makes common sense. It's actually the rationale behind stocks to begin with. Did you know that stock investing is older than bond investing? People used to become partners. That's what, when you're a shareholder, you're actually a partner, whether you realize that or not. You're a partner in that company. You bought a piece of that company. It might be a little tiny piece because one share is not a lot of a company that's got 1 billion shares outstanding, but it's still a share. You're still a partner. Why would you partner up with somebody? Generally so that you make a profit, right? If the profits go up over time, your share of that company should go up in value. And if you give it a long enough time period and the company does grow enough, that typically happens. That's typically how it works. So I'm going to show you how to break that down, make it a lot easier. Never mind the mumbo jumbo you hear on CNBC and you read about in the Wall Street Journal or Barron's, Investors Business Daily. They have a lot of stuff in there. A lot of them have some pretty good stuff. And if you really understand the language, it'll get a lot easier for you to understand what you're reading. And then you're going to find out that you only need to pay attention to about 2% of the total material that they publish. Yeah, the other 98%, you'll realize, this is not going to help. The generals direct the ISIS fight. That's the headline on this morning's Wall Street Journal, the weekend edition. There's no money to be made there. So if you're looking for investment advice or investment information, you can skip that article. You can also skip the economy stumbles despite optimism. Peter Lynch wrote a really good passage in one of his books about studying the economy. Most people think you have to get the economy right to be able to pick the right stocks. And he said he never spent more than 10 minutes looking at an economic report. This guy had the best track record of any mutual fund manager that's ever lived. Okay. And he never spent more than 10 minutes looking at an economics report. Now, why? I can tell you why. Because the correlation between how the economy's doing and the stock market and what people are willing to pay for stock prices is extremely hard to predict. It's hard to predict. That's why most people want to buy stuff that have any knowledge at all, like Peter Lynch did. You want to buy it below what you feel like is a fair price. How do you do that? Well, one of the ways of doing that is to figure out what a private firm would pay for a company. And then go try to buy stocks that are selling at less than those prices. Now, I know you're not going to have time to do that yourself, because that takes an enormous amount of time. But you can look at the mutual funds you're interested in, look at their top 10 holdings, and you do that little exercise, and you can get a really good idea of how good of a job the portfolio managers are doing managing that fund. So return is not the key. It's how they're achieving the return that's going to matter over time. Anybody can get lucky. You buy a stock that has no sales or earnings and it skyrockets because the drug that hasn't got FDA approval yet is supposed to cure, whatever it's going to cure. And the company's got a multi-billion-dollar market value with no sales or product. And then they fail in a phase 3 trial and that stock opens 80% lower. The mutual funds that had invested in it the year prior to that failure look like all stars, and then they look like chumps. So you want to avoid that if possible. You got to take those steps. And again, we're going to be talking about that. The seminar is free. There's no cost at all to attend. In fact, the Corporate College Tri-C is a great facility, very nice place, very spacious, a lot of big, screens there. So I put my stuff up on a computer. You can see it there. I normally don't give handouts. Okay, I normally don't give handouts, but this time I'm going to give you a handout. It's not going to be extremely elaborate, by the way. Nowhere near the number of words that I say on a regular 15-minute interval on my radio show, because I just can't write that much. But the main ideas, that's what you need to get. What are the big ideas? Is it a big idea to say, all right, I'm looking at the CD rates across country, and the best CD rates advertised this morning on a very popular website, 2.3% for a 5-year CD. Say, would you rather have 2.3% or 2.56%? Again, Not a trick question. Why am I looking at 2.56? Well, because I have a relationship with a custodian. You all would know. Unfortunately, they don't want me using their name without their permission, so I have to keep that to myself. But for now, you would all recognize them, I promise. They have an exchange that they built where banks can come and buy and sell CDs, and so can and investors can participate. How cool is that? So, and yields there are actually about 0.25% higher than that. How cool is that? And that's pretty cool. So we're going to be looking at how you can do that. You can do it yourself. If you're a client and you want a portion of your money invested that way, we'll do it for you. That's a part of the services that we offer, Bullington Capital. And I think it's pretty neat. Anyway, last section of today's program, by the way, we will talk about the Look Out for the Bull website. And a lot of you have been questioning that. I've been working. My team has been knocking themselves out trying to get this up and running. It is up and running. It'll change over time. So there'll be slight changes, but right now it's up and running. And the last 20 minutes of today's program, right after we come back from this next commercial break that's not going to start for a few minutes, we'll talk about that and some of the stocks that we're seeing there and how you might use that website to help you. If you like to participate in the market, or if you would like to participate in the market, this is a trend following procedure. It's the website's devoted to trend following, which is not the value thing that we were talking about earlier, where you're dividing the operating income or the earnings before interest and taxes, rather, by the cost of buying the entire business. Those are two opposite ends of the spectrum. Two totally different ways of managing money. And why would I teach two totally different ways? Well, because I'm actually kind of agnostic. I don't have a particular belief when it comes to the stock market. I think you can be successful doing both things. And those are the two opposites. You've got one that's based on price movement and momentum. You've got another that's based on the underlying value. They both have their challenges. I have a tendency to like them both. I like both of them. In fact, my trend following is kind of value oriented. When I'm looking at companies that are moving up really fast right now, I like to know that they're moving up fast for a good reason. That reason that I like the best is that the stock is underpriced. That's what I really like. That's when I say you are cooking with gas rather than cooking with some halfway wet logs that you're having trouble getting started in a fire anyway. So we're cooking with gas. When you've got a company that's undervalued and now it's moving up fast because it's come up on a momentum screen, I'm interested. Let me see. So that'll be the last portion of today's program. If you have a question, feel free to call us 216-901-0945, 216-901-0945. And how does this stuff all relate to you and your daily lives? Well, it doesn't really. This is stuff that you do if you really like the stock market. If you really like it, I love the stock market. I mean, I'm so lucky to be able to do something that I really like doing. Is it challenging? Heck yeah. That's one of the reasons I like it. I like the challenge. I like the hard way. But that's me. It's my personality. I never expected to get anything for free. Yeah, I haven't expected that you're going to have to work hard for anything you get. So it's not that big of a deal to me. Do you need to know all this stuff? Probably not. I think you really should know how to evaluate a company, though. It doesn't take that long. You don't listen to the people that make it really complicated. When we come back from these commercial breaks, I'll talk a little bit more about how you can uncomplicate that so you can go about your daily lives. Anyway, you're listening to Bill Bullington right here on 1420. Be back after these messages. And we're back. Hey, feel free to call us 216-901-0945. I did mention earlier that you could go to lookoutforthebull.com. It is operational. That's the website where we're doing the trend following with stocks. Again, that's just one technique. At the workshop, we're going to be talking about the opposite end of that approach, or just the valuation, just buying stocks that are giving you the best yields right now. Best yields. And we've got a little formula we're going to go through there. I'm going to show you a model that we worked on. It's very interesting. It's amazing about the stock market. You'll always be learning because it's always slightly changing. It's not changing radically overnight. But over a 4 or 5 year time period, it changes quite a bit. It's pretty interesting. It's changed from the entire time I started in the business. And I can go back and remember some of the things I used to do. And boy, those opportunities just aren't there anymore, or they just stopped working. And if you aren't keeping up with that, that can be a problem. And one of the hardest parts about that, by the way, is that when something's changing and you're still invested in it, you don't know that it's going to quit working until it stops. Actually, until after it stopped for a while. And in fact, I'm going through something like that right now. I don't know. There is a particular, the momentum strategies have not worked that well for about 3 years. And I don't know if it's actually a structural change in the way that market's behaving, or if it's just because the economic growth has been so anemic that it hasn't led to the types of conditions where this type of strategy actually thrives. So and we won't know that, by the way, until it's too late to do anything about it anyway. So the bottom line is that's why you've got to have more than one strategy in your portfolios working for you. And the value things have done very well past few years. A few years prior to that, it was all momentum. So I don't know if this is just a part of the normal cycle, which is not normal because GDP growth has been slower than it has been for longer than it ever has been in the history of this country, which is kind of interesting. There are lots of things that could kick that up, could pick up the GDP growth fairly quickly. And a lot of them are being introduced right now, which is very encouraging. It's just not moving as quickly as it would need to be able to put the focus back on that particular style. And it's not like it's lost money. I mean, it's made a little bit of money, just hasn't made nearly as much as some of the value stuff has over the past few years. So anyway, I'm still a believer, especially in the super broad categories. The models that have typically done the best are those that are using funds that you might find in a typical 401k plan, like a international emerging market, small cap, true mid cap, true large cap. Why do I say true? A lot of small company and mutual funds, they're going to invest in small companies, and that's what they tell you they're going to do, and they have a really good track record. If they have a really good track record, it tends to attract an awful lot of money. So at some point in time, they get so much money that they can't stay with the small companies anymore, so they have to move up into the medium size, and eventually they have to move up into large companies because they have so much money to invest, and there are only a limited number of investments that they can make in their category. They literally have to change what they're doing, which is good for them to recognize that, because the not changing what they were doing would create a significantly higher level of volatility for everybody. So, but it's not good for us as individual investors when they have to change what they're doing. We're not aware of it, because at that point in time, you may want to reevaluate and make adjustments on your own. So anyway, that's a conversation I'll actually have to carry on next week's show, because I really need to get to the stuff that we cover in the Lookout for the Bull. And essentially what we're doing with that website is publishing a list every day of stocks that have met certain criteria. This is a trend following strategy. I'll actually create a post over the weekend to put up on Monday or Tuesday, just because I see a couple things that I'm noticing, having done this for so many years. There are a couple of companies that look pretty good. I'll probably end up adding to the small amount of money that I manage this way for a small fund that I manage. They look pretty conservative, and their share prices look like they're going up pretty quickly. Actually, they don't look like they are. They are. They wouldn't make the scan if they weren't. So I think that's a very interesting thing to do. I like doing it. I don't do it with a tremendous amount of my money. No, I don't do with a tremendous amount. I wouldn't recommend that you do it with a tremendous amount of your money, because quite frankly, that's one of those things that has changed a little bit over the years, and it's gotten more difficult to be quite as profitable as it has been in the past. That doesn't mean you can't make money that way. It just means that, in the late 90s, it was easy. This was really easy. There have only been, I don't know, maybe 3 out of the last 15 years where it's been as easy as it was for 5 years in a row. That's a tough thing to have to come to grips with. When you're only going to have one good year out of every 4 or 5 years, and that one good year makes a big difference. But the rest of the time, you're not making a tremendous amount of money. That's very difficult, extremely difficult. And it's not like, by the way, that it was a year that began in January and ended in December. You have no idea when it's coming. All you know is that when it does come, if you're ready for it, you capture some of these fast-moving stocks. Yeah, it can make a big difference in your portfolio values. The rest of the time, you're plugging and sticking and moving and working around. That's one of the reasons I started the website. People that do this, we like to talk to other people that know the same things that we do, that are putting up with the same things that we're putting up. There's just a camaraderie that goes on there. And so we're trying to build an environment. I'm trying to build an environment where people can get together and talk about these things. Won't be doing it actually, we could probably take 15 minutes at least. So I'm going to be there around 6:30. The CDs is going to take 10 or 15 minutes. Yeah, so we'll talk about it a little bit. I just decided that right here. We'll talk about this. We'll give it at least 15 minutes at the pre-seminar seminar. That's not being advertised. Only the listeners to the program and the podcast listeners have an idea that I'm going to be there an hour early to talk about these things. On the lookout for the Bull website, the training sessions. There are 3 or 4. I can't even remember. That's how busy I've been. I've been doing a lot. I'll be so glad when tax time is over. Yeah, that is so close, and then it starts to slow down a little bit. The economy looks like it's actually doing fairly well. By the way, not that I pay close attention to that. I do pay close attention to how many stocks are rising versus those stocks that are dropping. That's kind of a big deal. And that number is slightly negative now. There are slightly more companies that are in a short-term downward trend than there are in a short-term upward trend. So it's getting more difficult to make money in trend following. That's been changing for several weeks now. And you had several weeks there, starting about a week and a half before the election. People think that the market took off after Trump got elected. No. Market started running about a week and a half to 2 weeks before the election, when everybody thought Hillary was going to win. So what does that tell me? Trump won. People thought Hillary was going to win. Trump wins. And the market resumes the upward trajectory it had already been on before the elections. What does that tell me? That tells me that people really wanted change, and they didn't really care what kind it was. And it was a big shock, to the financial markets. The Dow futures were down about 800 points overnight when Trump won. Market opens the next day down big time, then closes with a gain. That was interesting. And all that tells me is that change is looked at as a good thing. Financial institutions around the world were optimistic over change, not necessarily whose change, just change. And that ran for a good, 6-7 weeks. It's kind of been going sideways and actually started to lose some steam here. So we're going to need to, by the way, that's not uncommon for this time of year. Your best quarters are typically the last quarter of the year and the first quarter. So it's kind of normal that the market would start to drift off right about now, this time of year. But the people are blaming whatever they're going to blame. I don't think you can actually say exactly why that stuff happens. And it looks like we are going to have a phone call. By the way, I keep forgetting to give the phone number out here. Sorry about that. I've only been doing this show for 20 years. It's 216-901-0945, 216-901-0945 if you'd like to call us. You can also reach me, bill@bullingtoncapital.com. If you want to email, you can go to my website, Bullington Capital. There's a contact us form there. That's where you would sign up for the workshop that's coming up. We're going to be talking about these things. And I've got a quick caller here. You got a question about Dell?
Good morning. It's Daryl.
Oh, that's funny. How are you doing?
I'm doing well. You thought I had a question about Dell computers?
Yeah, I guess so. Whoever who answered the call just thought that they heard it wrong. That happens quite a bit, by the way.
Yeah, I have one that's not working well. If you can help me with it. No, I'm just kidding. Hey, I just wanted to say hello and wish you a happy Easter and thank you for all the good stuff you do for me and my wife. And I'm looking forward to the seminar.
Oh, well, thanks. How's the Amy's office going?
Amy's office is going well. Yeah, we're getting a few leads here and there and working with some people.
Thank
good. You for asking.
Oh, no problem.
Yeah, so appreciate you mentioning that. And that's it. That's all I got.
All right.
It's my story. I'm sticking to it.
All right. Well, hey, thanks for calling. I'll see you soon.
All right. I'll be looking forward to it. Thanks again, Bill. Say hi to everybody in the office.
All right. Wow. That was it. Man, that hour went by fast. You're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420 The Answer. You can find us on iTunes.com. Just go to Bullington Capital Report. Have a good weekend, everybody. Good luck and good investing. And happy Easter.
You just caught another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group, WHK Cleveland.